Good afternoon. I am recording this video to you on a Friday, so you get to see me in my casual, tie-less Friday look today. Now, we are in the middle of earnings season. It's the period of the year when most companies in the S&P 500 report their earnings for the fourth quarter of last year. Now, we have 24 positions in our portfolio, and I'm not going to bore you with the updates and results from every single one of them as they report. But I do want to highlight 3 companies that have reported earnings last week because they signal and give us a lot of information about the overall state of the US economy and how the investments that we're making are performing in the current environment. The companies I want to talk to you about today are Union Pacific, Canadian Pacific, and NVR. Now let me start by mentioning Canadian Pacific and Union Pacific. These 2 companies are railroads. They're 2 of the largest railroads in North America, and they both reported earnings last week. Both companies are really firing on all cylinders, and railroads are a great way to look at the overall health of the macroeconomy in North America. Because railroads transport so many goods, they are a way to gauge the overall health of the economy, the level of industrial output and demand. And in both cases, Union Pacific and Canadian Pacific moved a record number of goods across almost all of their categories: grains, cars, energy products, intermodal, you name it. Both companies reported very strong growth in operating earnings of over 20%, and because of their lower tax rates, they've reported gains in earnings per share of close to 40% in both cases. Now, both these companies are operating in a fantastically strong macro environment where the economy is very favorable to them, and they are capturing a lot of the gains and the value they create. Now, I want to point out one important fact about these 2 businesses. Both companies are performing extremely well, and we expect them to continue to grow their earnings per share of somewhere between 12 to 15% per year over the next decade or so. Neither of these companies is particularly strongly undervalued. So these companies are, I would say, slightly undervalued, but they're not dramatic bargains by any chance. And I think this is important to point out because it highlights a key feature of LRT's investment strategy. We're not trying to buy super cheap, beaten down companies. We're looking to invest in businesses that may be close to their full value, but which we believe can sustainably and quite predictably grow their value and increase their earnings over many years to come. And I believe that's the case with Union Pacific and Canadian Pacific, which we both own and we're very happy to own at the current valuations. Both companies are doing fantastically well, they're well managed, and they're very shareholder focused, and they are returning cash to shareholders in many different ways. Now, the third company and the final company I want to talk to you about today is called NVR. You may not have heard of NVR before because it is a small home builder which operates primarily in the Mid-Atlantic region. Now, owning a company like NVR is quite unusual for us at LRT because NVR is a home builder and most home builders do not have a sustainable competitive advantage. So what makes NVR different? NVR is unique amongst the publicly listed home building companies in that they do not do land development. They only build houses. So this is important to understand. Most large publicly listed home builders acquire large swaths of land and then slowly develop it and then build homes on top of that. This land development activity can be very profitable in an upswing in the housing cycle because land values rise substantially. But it also means that these companies can lose a lot of money in the downturn. So they are very capital intensive and they're very cyclical as a result. But NVR is different. They never develop land. They only use options on land, and they only acquire and execute those options and acquire the land when they have a signed contract to build a home. Now, the housing market in the United States in the last few months has begun to soften. The price appreciations have slowed down, the increases in the mortgage rates have taken a toll on mortgage applications, and there's an overall softening of the housing market as it has become more expensive and therefore less affordable to Americans. Remember, for the last 5-6 years, the gains in home prices have far exceeded the gains in wages. Therefore, homes have become less affordable. And so NVR and the housing market itself is going through a slow patch, a rough patch, if you will. So I want to highlight NVR and pinpoint how well the company is performing, both as a company and as an investment in an environment which is not ideal, which is different from our railroad investments, which are operating in a fantastic, ideal environment. So NVR only grew its operating income by approximately 6%. However, because the company is very capital efficient and generates lots of capital and can return that capital to shareholders, NVR has been able to buy back, retire over 8% of their shares last year. So in other words, per share income or per share operating income rose by almost 14% last year. But what's more, the reduced tax rate that the company now operates under meant that operating earnings per share, net earnings per share, skyrocketed quite dramatically. So NVR is a business that operates in a tough industry but has a nice competitive advantage and is very good at allocating capital. Now, the growth of the business is fairly limited in its opportunities, but the current valuation is very undemanding. And what I mean by that is that NVR trades at approximately 12, maybe 13 times our forecast for the earnings the company will have next year. And so this is a business that is very stable over time. This is a company that's been profitable every single year for the last decade, including 2007, 2006, 2008. And remember, this is a home builder. They were profitable in the worst housing environment of the last century, I think. And yet, this is a business that you can buy today at 12, maybe 13 times next year's earnings. So we think the price is right. We think the value the company is creating for shareholders is excellent. And we think they can continue to grow their earnings per share at somewhere between 12 to 15% over the foreseeable future. So with that, I want to thank you for listening, and I look forward to hearing your questions.